Hello and welcome everyone to this weekly market recap for the holiday shortened week ending April 18th, 2025. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com. It's a pleasure to be with all of you again this weekend. Pretty interesting week again last week. We had a little bit of volatility, saw some bifurcated action in our major indices, saw some leadership from small caps. We had a speech from Fed Chief Powell, which kind of rattled the market a little bit. Again, for me, I think it was much the same, but he did mention that there could be some serious challenges ahead, especially if the dual mandate that the Fed kind of is responsible for, has problems, has issues on both sides. So, in other words, if we run into a period of economic weakness, while at the same time still trying to stabilize prices, that could be a double-edged sword for the Fed. I'm not sure it was necessary to say that. I think most folks know that. I mean, it's always the case. And same could be said for the fact that, hey, maybe inflation's not a problem and the economy stays strong. That's a possibility too, and that would be a really good scenario. So I don't really understand sometimes why the Fed chief likes to editorialize like that. But anyhow, it's just my opinion. What we did see was the ECB, the European Central Bank, this past week, lower rates for the seventh consecutive meeting. And as a result, I think, the market's looking at this saying, hey, Germany and some of the countries are going to benefit from these lower rates, likely to see economic improvement ahead. Meanwhile, here in the U.S., the Fed is standing pat. And so when you start thinking that, the European markets could be stronger, or at least that the economy in Europe could be stronger down the road because of rate cuts there, that I think in part at least contributed to a very weak dollar. And that in turn sent gold back up to its first high above $3,300 an ounce. So a little bit of that going on in terms of, the Fed and what the Fed may do, what the Fed may not do. And I don't know, again, I think that there probably was a lot more, there was a lot more reaction to the Fed than probably should have been, in my opinion. I really don't think that much new was said at that particular speech. Anyhow, we did see small caps do better this past week. That was a good thing. It's been a while. Maybe, it's hard to say why exactly, because the small caps had been underperforming. But maybe there's still the belief out there at some point that the Fed is going to cut rates. Again, really difficult to say at this point. We just take it a day at a time. I do still like a lot of what's going on underneath the surface of the market. We remain in downtrends. I'll show you the charts on the major indices, but clearly we are downtrending. The technicals really don't show us anything positive. It's just some of the signals underneath. If the technicals were to improve, that would simply confirm some of the signals, some of the more bullish signals, or at least growing bullish signals under the surface of the market. So anyhow, we'll take a look at all of this and a little bit more as we go through the action. So let's take a look at what happened on, last week. It was, again, a holiday shortened week. So we only had 4 days last week, but you can see the Russell 2000 gaining 2.6%, mid caps up 2.23%. Transportation finding a way out of that last spot. We haven't seen that very often. Anyhow, transportation up nearly 1%. S&P was up 0.25%. NASDAQ down about 0.5%. And the laggard was the Dow Jones, losing more than 1%. A lot of that had to do with United Health Group, which reported its earnings last week, and they were not very good. And the stock took a huge hit, I think dropping over 22%. We'll take a look at that UNH chart a little bit later in the show. Moving on to the sectors, wasn't a great week in terms of rotation. Again, market was kind of flat, a little bit of strength in small and mid caps, but for the most part, pretty flat. But you can see all of the groups except the three most aggressive groups were up last week. So we had energy leading up nearly 6%, real estate up 5.5%, or almost 5.5%. Materials up more than 3.25%. Staples and utilities both up more than 3%. Financials and industrials up a little bit closer to 1.5%. And then healthcare was the laggard among all of the gainers last week. Healthcare gaining less than 0.5%. But you take a look at the three aggressive groups: communication services, technology, consumer discretionary. Wasn't a huge loss last week, but they were all down. Communication services and technology down fractionally. And then we had the discretionary group down 1.33%. And when you consider that versus staples going up 3%, that's not a great look in the market. And so this is going to be something that we'll need to continue to monitor as we finish out the month of April and move into May. But overall, I still believe when we're looking intraday and we get past a lot of the gap downs, still looks to me like there's a lot of accumulation taking place in this market. And that can be a very significant sign of a turnaround coming back to the upside. So going to continue to monitor it. I certainly don't think we're out of the woods yet. Like I said, technicals still point down. We're still trending down, putting in lower lows, lower highs. We haven't taken out any key resistance. And so let's take a look at those charts, see where we are right now. Dow Jones Industrial Average topped back at the beginning of February. A little different than the overall market, the S&P 500. When I talk about overall market, to me, 500 of the largest companies in the world. That's probably a little bit better index to follow than the Dow Jones. But S&P 500 topped, I believe it was on February 19th. You can see the Dow actually going up and putting in a double top right at the end of January 2025. And this index had started to roll over by the time the S&P 500 put in its high. But you're going to see very similar indices as we look at all the major indices. They're all down sloping. They're all putting in lower lows, lower highs, lower lows, and they're all remaining mostly below the declining 20-day EMA. All of that bearish, no doubt about it. Price action right now is bearish. Moving forward, taking a look at the S&P 500, here's your top on February 19th, but essentially the same chart, down, back up, tried to hold on to support, failed. We got the gap down with the tariff news back earlier in April, rebounded with the 90-day pause in tariffs for most countries. That's what brought us all the way back up to the 20-day. We've tried to get through the 20-day on a few occasions and have not been able to do so. Rolled over again late last week. So again, technicals not looking very good at this point. 55.21 is still the number that we need to get through in terms of price resistance. That was the breakdown below that mid-March low. I think that was March 13th. So we gapped down with the tariff news, heavy volume, and that's where we lost that key area. But when I talk about signs of accumulation, I'm talking about the bottom, where we went down as low as 48.35, but we closed back over 5,000. So there was a lot of buying. If you look back at the bottom of the 2022 cyclical bear market, it happened in the middle of October with a poor CPI report that had come out. And we had a huge gap down, and we had this really nice rally and a very, very strong hollow candle. That was the bottom. And so we're seeing something somewhat similar. And then 2 days later, with the pause in the tariffs, you can see one of the best days in market history, coming all the way back up to that 20-day moving average. But one of the problems right now is that the volatility still remains elevated, and we've got a very, very wide trading range, 55.21 to the upside and down closer to 4,800 to the downside. And normally we have a trading range which could span 75 or 100 points maybe on the S&P 500. And this, we're talking about almost 10 times that. So definitely we got room to be extremely volatile, price action to go all over the place. But I would watch 4,800, that area to the downside, and 55.21 is the key resistance back to the upside. NASDAQ. NASDAQ also topping in mid-February. Same kind of a situation here, still trying to get back through some key resistance, which is probably close to about the 19,250 level. Also trying to get back through that 20-day moving average. Moving on to the small caps, the IWM, they topped actually back at the end of November. So small caps had already topped long before the other major indices did. And you can see still similar pattern though since its top. We've had lower lows, lower highs, and continue to battle and fail at the declining 20-day moving average. Lastly, mid caps also topping back at the end of November. Same deal. Lower lows, lower highs, failing to get through the 20-day moving average and not able to negotiate price resistance. So as you look at the technicals, if I just stopped right there and I didn't do any research, I would say the market's still downtrending and we're probably going lower. So it's only these other signals that are telling me that that may not be the case. Most notably some of the rotation, and especially during the day action, which to me certainly seems like many of the key stocks, many of the key areas of the markets, industry groups, and so forth are being accumulated with this weakness. I think it was Warren Buffett back in 2008, said essentially that traders, investors should love bad news. And bad news gets you discounted prices. And I want everybody to think about, because I know I've said this before, but when stock market's going up, we have a tendency to say, well, things have gone up too much. I want to see a pullback. I want to get in on a pullback. And then you start to see selling and you get too scared to buy on the pullback. Next thing you know, the market's back up again and you've kind of been manipulated. If anything, when the market goes down, a lot of times people get scared and they sell positions rather than adding or, buying outright to begin with. They wait too long to get back in. This is an opportunity. Market doesn't go down 20% very often. I talked about that during our event, which I'll talk about a little bit later, that we had on Saturday. Over the last 75 years, we've had 15 bear markets where we've dropped at least 20%. So these are rare. 15 times in 75 years, that's basically one every 5 years. 12 cyclical bear markets, 3 secular bear markets over the last 75 years. So again, we don't see these kinds of sell-offs. And if you're guilty or you remember and think back and say, well, I've been waiting for a pullback to get in, you got no excuse because you got a 20% pullback. Right now, we're not down 20%, but at the low, the S&P 500 had dipped just a little bit more than 21%. Moving on to the VIX. So let's take a look a little bit at the sentiment, because whenever we get into a high volatile or highly volatile environment where we see the VIX moving up into the 20s, 30s, 40s, 50s, the tendency is for the high VIX to mark the bottom. Not in every case, but in many cases. And so being up into the 50s and now rolling back over with a VIX that has a value about half of what it had a little over a week ago, it's encouraging. Again, we haven't taken out any key resistance areas, but we do have fear coming out of the market. And I think as you start to see more and more fear coming out of the market, you'll see more and more buyers step in. So this is something to watch as the VIX comes back down. I don't think we're out of the woods completely until the VIX goes back down below 16. We're still at 29. It's still very elevated. Equity only put call ratio. I've talked about how the 5-day moving average of the equity only put call ratio marks many short-term bottoms and can mark long-term bottoms, but better marking short-term bottoms. And we saw that a little over a week ago. We spiked to 0.73. 0.75 is kind of the level that I like to look for. You can see back in September and in August when we had lows then, we had the 5-day moving average getting up past that 0.75 level and approaching 0.80. Both of those were key bottoms, short-term and longer-term bottoms, from back in August and September of last year. So this move up to 0.73 didn't quite get as high as we had before, but you can see looking back over the last 5 or 6 months, the highest we've seen. So definitely more and more bearishness creeping into the options world, which again, I think is bullish for the short term. Now, one of the things that really has baffled a lot of folks so far this year has been the US dollar, which has been going down really since the beginning of the year. It's down probably 10% since the high was reached right at the beginning of the year. You can see this line right here moving down. That's the US dollar rolling over. I've connected the lows from 2011 and 2021. And we're not quite there yet to that trend line, but we're getting close. And I also drew a support line where over the course of the last 3 or 4 years, you've seen 100 be pretty good support for the dollar index. We're down to 99.23. So we're just a little bit below that support level and just a little bit above trend line support. So this is going to be a key area, I think, around 97 or 98 up to 100 to see if the dollar can get some footing and start to turn back to the upside. But the weak dollar if you take a look, weak dollar normally helps energy, materials, especially gold. Gold benefits in all of my studies. If you look at when gold outperforms the S&P 500, it's usually one or two factors or both. It's normally a falling dollar or it's rising volatility. And right now we have both. And as a result, this basically 14-year downtrend in gold relative to the S&P 500, I'm not saying it's over, but it's certainly in the short term, gold is a big outperformer versus the S&P 500 at this point. And again, I think it's coming on the heels of the dollar weakness and the high volatility. Gold is seen as a hedge against the market, and gold is denominated in dollars. So when the dollar goes down, gold usually goes up. When the dollar goes up, gold usually goes down. But there are other factors as well that you have to consider. And one of those is volatility, and the high volatility certainly is helping gold investors right now. The other thing that you need to be aware of when the dollar is falling, I'm showing you a chart here of the German stock market. This is the DAX. And you can see the DAX going up, pulling back, very similar to the S&P 500, then rallying back, trying to get through the 20-day. Has not done it yet. If you look at the DAX relative to the S&P 500, that's what this second panel is all about. You can see that from November through March, once the Fed started talking about no more rate cuts here in the U.S., I think that was kind of a license for folks to, at that point, start moving some of their money into foreign markets, mostly because the foreign markets were seeing a lot of rate cuts, which could lead to economic expansion down the road. The Fed is pausing those rate cuts here in the U.S. So I think that's part of what we're seeing here in terms of Germany outperforming the S&P 500. But here's an interesting point. A lot of folks don't realize this, but if you buy an ETF that tracks these foreign markets, here, EWG tracks the German DAX. So if you look at what's going on here in the German market, the ups and the downs and the uptrend and then the big down, then the back up, you can see the same thing here with the EWG moving up, kind of going sideways, big move up, down, back up again. So it looks like it's the same, right? Here is the EWG relative to the German DAX. Now it tracks, here in the US, if you follow the SPY, the spider, it tracks the S&P 500 almost perfectly every single day. The only difference is dividends, when dividends are paid. But here, the EWG and the German DAX are like, EWG's outperforming and then it's underperforming. How could it be tracking the index if it's moving up and down like this, right? Well, the difference is there is a currency component. When you buy the EWG, which is a US ETF, and it's tracking the German stock market, there is a currency translation component that you have to figure in. And so that's what I'm going to show you here. Here is the ratio of the EWG to the German DAX, up and down and up and down. And down here is the dollar. Now watch what happens. When the dollar is going down, the EWG outperforms. As soon as the dollar bottoms and starts to turn up, the EWG begins to underperform. And then when the dollar hits a high and starts to move back down, the EWG starts to outperform again. So a weak dollar adds to the performance of the EWG. It actually does better than the German index. So if you're looking at foreign markets and you think foreign markets are going to be stronger, and you think the dollar is continuing to go down or will continue to go down, these ETFs, these international ETFs, can be a great place to invest some of your money. And I've talked recently about at least considering adding some international exposure to your portfolio. That's not really what we do at Earnings Beats. We focus on US stocks, but I don't think it's a bad strategy. At least, a little bit as a hedge against the US stocks in case stocks continue to go down or the dollar continues to go down. But just keep in mind and remember that if the dollar starts to turn back up, that ETF, those foreign ETFs are going to underperform their underlying indexes. So if you believe that the dollar is going to come back, the EWG might not be a great hedge. So it just depends on, what you're thinking in terms of the dollar and our economy versus foreign economies. All right. I do want to mention to everyone, we had an event yesterday. I mentioned this a little bit earlier, and I wanted to just point it out. But you can go right here on YouTube and just type in my name, earnings beats, whatever. And here's the title: Bear Market 2025: Separate Noise from Reality. But this is with Q&A, it was over 2 hours. I probably talked for about, I don't know, an hour 45 or something before I went into questions. Talked a lot about what I'm seeing in the market. Obviously, we're seeing the downtrend in the market. That's clear. I mean, that really is not disputable. We're trending down. We're below key moving averages. It doesn't look good. But when you're going to call bottoms don't form at the top. Bottoms form at the bottom. So if you're trying to find the bottom, you're never going to be able to use technicals completely because you're downtrending. You're not going to see a bottom when you're downtrending. You're going to think you're going to keep going lower. So you have to start to anticipate those bottoms, and you can do so by following some of the under the surface signals that we like to follow at Earnings Beats. Anyhow, you might want to check that out. We talk a little bit about that. We talk about sentiment. We talk about market manipulation. We talk about seasonality. A lot of good stuff in there that I think you can, walk away with some pretty good nuggets on what you might want to do here over the next few months. So be sure to check that out. Also want to mention that we have a flash sale. This is a 48-hour only flash sale that started on Saturday. It'll end up Monday at midnight. But whenever we do these free events, and we have a lot of new folks looking, we want to give a really special offer for folks to join us at Earnings Beats. So I just want to make sure everyone's aware that we do have this flash sale. Also, another way that you can get to our video, if you'd like a copy of the recording, we can send you a copy of the recording. If you on the screen, we have a slide up where you can just scan the QR code, and that'll take you to a landing page where if you sign up for the event was Saturday, so the event's over, but if you sign up, we'll send you a copy of the recording. So you can check it out that way as well if you'd like. All right, last thing I wanted to go over today is I want to go through some of the earnings from last week. So I'm going to call them studs and duds. We got 5 that I thought were studs last week. I think we got 3 that were duds in terms of earnings reports and how the market's reacting and how these stocks are performing on a relative basis and maybe how they're doing in terms of accumulation distribution. Here you can see Johnson & Johnson. Their AD line is at a 52-week high. That looks great. Stock had been beaten up a little bit, but it's come rallying back, and look at it relative to its peers. Now, keep in mind the pharmas have not been very good. We were in a pretty steady downtrend going into the beginning of 2025. We bounced a little bit on a relative basis, but still not looking great. But this is one of the top performers in the pharmaceuticals. And Johnson & Johnson did report earnings that beat 277 versus 257. They also topped their revenues. And to boot, they pay a 3.3% annual dividend. So anyway, I think the stock looks pretty good in this kind of a market environment. It's more defensive, and it does pay a dividend, likely going to perform better than the overall market if we keep going lower. Now, if we turn around and go higher, probably will lag, but it should go higher, at least this, as long as it's showing relative strength versus its peers, then it should have a pretty good chance of moving up. And like I said, it does pay a 3.3% dividend. Another stock that I'm going to say was a stud with its earnings, ABT. This is Abbott Labs. Again, AD line pretty strong. Stock trying to get through $132. I really want to see that level taken out. I could see a couple of things transpiring here. Number one, a breakout above 132 could send us quickly back to 140. You can see the relative strength here versus the pharmas as well. And Abbott Labs pays a dividend of 1.8%. Now, one thing, because we had this false breakout and we failed to get through 132, one possibility is that we go back and put in an inverse right shoulder. So this looks like off of an uptrend, a possible inverse head and shoulder pattern, which is bullish if you take out the neckline. So you come down, you print the shoulder, you move back up left side of the neckline, You go to a lower low, you put in a lower low, that's the inverse head. Come all the way back up, test the right side of the neckline. And then if you get a right shoulder, which could be anywhere from this gap support level around 126 down to maybe 124, that would make it much more symmetrical. In that area, if that right shoulder were to print and then we make the breakout back above 132, I would see a measurement of 144 to 144. I'd say that's where we're heading. So that's a possibility. Anyway, just wanted to point that out. One more stud. This one is kind of a partial stud. AD line, not very good. So that's a little worrisome. But in a market that's been going straight down, I mean, back at the beginning of this month, we were testing a move back up to highs, all-time highs, I believe, on Travelers. Then we came down with the market, went all the way back down to support at 230. Now we're all the way back up again, not far from the breakout level. They did beat by a wide margin on earnings, $1.91 versus 64 cents. But that seems like maybe there was a one-time in there or something. I didn't do any research on that number, but Travelers did miss their revenue. So it just seems odd that they would beat their earnings per share number by such a wide margin when their revenues came in slightly below expectations. So again, I don't know if there's some kind of a one-time thing that's in the earnings, but that was a really big beat on earnings. Schwab, another one that I'm going to throw out there. Schwab, AD line, pretty strong, been strengthening for the last 3 or 4 months. And then you can also see on a relative basis to investment services, we have probably about a 9-month relative high on Schwab versus its peers. So I think that looks pretty good. And then the last one, and this one was a pretty good stud, reported after the close on Thursday. So we have not gotten a live market reaction yet. Stock was up after hours about 3% on Thursday. So we'll see if that carries over the weekend to Monday's open. But Netflix, you can see that AD line's been going up. And from a price perspective, Netflix has held up better than most stocks. It got to a high back in February, 1,060. It got down as low as 820 to check or to test some key support. And now it's come back up. And now with the gap up, potentially, last price I saw on Thursday after the bell was a little above 1,000. So if we can clear this 1,000 resistance level on the open, I think it opens Netflix up to a possible move back to test that high at 1,060. Netflix did beat by a wide margin their earnings. They're expected to come in at $5.69 a share, $5.69, and they came in at $6.61, so almost a full dollar above expectations. Their revenues just about matched expectations, very, very slightly beneath. But market loved the earnings per share beat, and as a result, stock was up in after hours. So we'll see what happens on Monday there. And now for the duds. I'm going to give you IBKR, and all I can say is what a difference 3 months makes, because this stock was absolutely on fire. I will say also here the AD line remains fairly strong, so maybe the stock comes back, but I would really like to see it get back up above about 180, 185, maybe back through that 50-day moving average and the recent price resistance. That would help the case technically for this stock, but you can see from 235 went down over 100 points in 45 days. I mean, that's a lot. 40% on the stock in about 45 days. On a relative basis, you can see this was one of the best stocks in the investment services area up until 2 months ago. Now we've seen a really big drop off in terms of relative strength. So not a great reaction to its earnings. They missed on their earnings, $1.88 versus $1.92, and they also missed on revenues. So not a lot good going on there. Need to see technical improvement here before I would consider IBKR. UNH, this was from Thursday. This was a bloodbath. Stock had closed at 585 on Wednesday. Thursday opens up 100 points lower and continues going down. Seems to be on a crash course with that February low down below 440. That's what I would be looking for on UNH. Then maybe we can bounce off of that. But the interesting thing is we had pretty decent AD line at the time, and relative strength was coming up. So I would say that this report kind of caught a lot of investors off guard. And so not a good look here. And because this is one of the most high, what's the right word? It's one of the largest components of the Dow Jones. And so when you get one of the largest components dropping 22% in a day, that's why we saw the Dow Jones lagging the other indices last week. All right. And the last one I have for you is Manpower, MAN. AD line just continuing to fall apart. This is a very poor AD line. The chart was already in a downtrend and has just accelerated that downtrend over the past 2-3 weeks here in April. And obviously did so on Thursday with massive volume relating to its earnings report. Manpower, you can see on a relative basis now to 52-week low, and it's not exactly in a strong area of the market relative to the S&P 500. That would be the business employment area of the market. So not good. I can tell you, by the way, UNH missed on its revenues and on its earnings per share, 720 versus 727. And then Manpower beat revenues, but missed on earnings. Came in at 0.44. Market was expecting 52 cents. So it came up a little bit shy. But anyway, that's what we got. There's not a whole lot going on in terms of economic news in the week ahead. So it's going to be mostly earnings driven. And of course, any news coming out about tariffs, anything of the like, that nature could have an impact on the market. But I would continue to watch that trading range. It's a wide trading range. I think we could go anywhere within it. I think we could go back to 4,800, put in a double bottom. I think we could go right back up to the high, or the breakdown, which was 55.21 on the S&P 500. But let's see which way we break there. If we break back to the upside, given a lot of what I'm seeing in terms of manipulation, that could be a really strong message that a lot of bad news is already priced into the market. So keep an eye out for all of that. Anyway, have a great rest of your weekend, and I will see you next weekend. Happy trading.